Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Circle Internet Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. We really appreciate the support as we navigate these complex market stories.
Yeah, we really do.
And today's story is, it is defined by a massive glaring contradiction. Imagine looking at a stock chart and seeing a painful, aggressive 37% drop in just 30 days.
Which is brutal.
Exactly. Retail investors are fleeing for the exits, hitting the panic button. But right underneath that surface-level wreckage, this company just secured the keys to one of the most heavily guarded, complex financial gates in the world, which is Japan.
Right. It's a huge deal.
So it is this moment of severe short-term pain clashing with a massive structural breakthrough.
Exactly. And before we unpack how those two forces are colliding, we want to share a useful chart tool for investors and traders who are navigating this exact kind of volatility.
Yeah, so needed right now.
Right. So if you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description. It's a TradingView indicator suite that gives you visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
It's super versatile, too.
Very versatile, yeah. It can be used across markets like stocks, forex, crypto, gold, indices, futures, and a lot more. But just remember, VIP Algos is an educational chart analysis tool only.
Right.
It is not financial advice, it does not place trades for you, and it does not guarantee profits. Trading involves significant risk, so always manage your risk carefully and do your own research. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context.
Yeah, let's do it.
So, talking about the context of this 37% drop.
Yeah.
When you see a haircut that steep in a single month, it is so easy to assume this is just another highly speculative digital asset catching a cold because Bitcoin sneezed.
Right, the usual crypto volatility.
Yes, exactly. If the broader market is having a bad week, anything tied to digital assets usually gets punished. So I guess my question is there a genuine case to be made here that this isn't just a proxy for retail speculation?
There absolutely is. For strategic investors, completely reframing your perception of what Circle actually does is, well, it's the key to understanding the long-term thesis here.
Okay.
Because this is not a retail speculation story at all. It is a B2B cross-border settlement infrastructure story. They are attempting to basically rewire the very foundation of global money movement.
Let's break that down for everyone listening, because a global money movement sounds incredibly abstract.
Sure.
Right now, if a business in New York needs to send $10 million to a supplier in Tokyo, that money doesn't just zoom instantly through a fiber optic cable, right?
Not at all. It relies on the SWIFT network, which is essentially just a highly secure messaging system. SWIFT doesn't actually move the money. It just sends instructions between banks. And because banks don't completely trust each other, they rely on intermediary corresponding banks, so they have to maintain what are called Nostro and Vostro accounts.
Okay, stop right there. Nostro and Vostro accounts. What does that actually look like in practice? Because it sounds like banking jargon.
Yeah, it totally does. Think of it like prepaying a massive bar tab in every single city you might ever visit, just in case you want to buy a drink there someday.
Oh, wow.
Yeah, banks literally have to park billions of dollars of their own capital in foreign banks across the globe just to facilitate these international transfers.
That sounds incredibly inefficient. You're trapping mountains of capital that could be, used for investments or lending.
Exactly.
Just letting it sit there in a holding pattern. Plus, moving through all those intermediaries takes days, and you are bleeding fees at every single stop.
Right. It traps capital in transit and severely limits the velocity of money. So Circle is building the digital plumbing to replace that entirely.
By using their stablecoin.
Yes, by using their USDC stablecoin on blockchain infrastructure. They want to allow institutions to settle that $10 million transaction in seconds directly without the messaging intermediaries or the trapped capital.
Making them the base layer.
Exactly. They are trying to become the base settlement layer for global financial institutions.
Which means we're looking at a structural turnaround profile here. This isn't a quick day trade scenario.
No, definitely not.
You're looking at a company trying to literally upgrade the operating system of the traditional financial system. That requires a very specific type of investor, patient capital.
100%.
You have to be willing to look past the current macroeconomic volatility and wait for a massive fundamental re-rating once this new plumbing is fully adopted.
Precisely. You have to look at the actual utility of the plumbing, not just the daily token price or stock price.
Right.
That gives us the bigger picture. Now let's look at the fundamentals.
Okay, but this is where my skepticism really kicks in. Let's look at the actual business model, because they just reported their first quarter earnings on May 11th.
Right.
They posted an earnings per share of 21 cents on roughly $694 million in revenue. And they missed consensus estimates.
You did, yeah.
So if they are moving billions of dollars in daily volume but still missing revenue and earnings targets, it forces a very basic question. How does this business actually generate sustainable cash flow?
It's a great question. And to answer it, you have to look at them less like a software company charging, subscription fees, and more like a high-tech treasury combined with a digital toll bridge.
Okay, I'm following.
Their primary product is the USDC stablecoin. Now, USDC has a massive market cap of $73.8 billion. For every single digital dollar issued on the blockchain, there is a real US dollar or a dollar equivalent, like a short-term US Treasury bill, sitting in a highly regulated reserve vault.
Wait, so if they are a digital toll bridge, are they charging businesses massive fees every time a digital dollar crosses the bridge?
See, that's the genius of it. The bridge itself is incredibly cheap, almost free in many cases, which is exactly why institutions want to use it.
Okay.
Circle doesn't make its primary revenue by charging you a toll to cross. They make their money on the massive pile of cash you handed them to get your digital tokens in the first place.
Oh, I see.
Right. Circle keeps the interest generated by those $73.8 billion in reserves.
Oh, wow. Okay, so it's fundamentally a balance sheet business model. They're essentially operating a colossal money market fund, but wrapping it in highly efficient digital utility.
Exactly.
So if U.S. Treasury bills are paying 5%, Circle is pocketing the yield on tens of billions of dollars without taking on the default risk of traditional lending.
You nailed it. And their true competitive moat isn't just the underlying blockchain technology. I mean, theoretically, tech can be copied. Their actual moat is regulatory clearance. USDC is the very first global dollar stablecoin approved under Japan's incredibly strict financial services agency framework.
And we really need to emphasize for you just how big of a deal that Japanese approval is.
Yeah.
Because Japan is a post-Mt. Gox environment.
Yes.
For those who don't remember, Mt. Gox was a massive cryptocurrency exchange based in Tokyo that spectacularly collapsed back in 2014.
It was a nightmare.
Total disaster. They lost hundreds of millions of dollars of customer funds. It was unprecedented.
Right, and the fallout from that collapse meant Japan wrote some of the absolute strictest, most unforgiving financial regulations for digital assets anywhere on a planet. They do not mess around.
Not at all.
So for Circle to walk into that regulatory environment, open their books, and get the official green light from the Japanese government, that positions their token as a fully credible, legally bulletproof instrument for traditional Japanese institutions.
It totally separates them from the sketchy stigma of retail crypto trading.
Exactly. Furthermore, instead of using their cash flow for short-term stock buybacks just to artificially prop up their bleeding share price, they are aggressively reinvesting in global infrastructure, specifically building out entities like Circle Japan.
That gives us the business picture.
Yeah.
Now let's move to the catalyst timeline.
Perfect.
Because, okay, they have the hardest stamp of approval in the world, which is a fantastic moat. But a legal stamp of approval doesn't magically pay the electric bill.
No, it doesn't.
So how do they actually turn that regulatory paperwork into hard revenue?
That brings us to the biggest catalyst on the board right now, their Memorandum of Understanding with Nomura.
Okay.
The target here is Japan's foreign exchange market. And to put this in perspective, the Japanese foreign exchange market processes $440 billion in daily volume.
Wait, 440 billion?
A day.
A day.
Yeah.
Every single day. By integrating their infrastructure directly with Nomura, major businesses will be able to swap Japanese yen for USDC instantly.
It reduces settlement times from multiple days down to mere minutes. Going back to our earlier example, if a Japanese conglomerate can instantly swap and settle funds globally without waiting 3 days for SWIFT and corresponding banks, they free up massive amounts of working capital.
Because the money isn't just trapped in transit.
Exactly. It increases the velocity of money for the entire Japanese corporate sector.
But let's hit the brakes on the excitement for a second. The full integration and rollout with Nomura isn't planned until 2027.
That's true.
That is 3 years away. In the financial technology space, 3 years is an absolute eternity. I mean, entire market cycles happen in 3 years.
Yeah, it's a long runway.
Are investors really expected to park their capital and just wait that long? I'd argue the immediate catalyst you need to watch isn't Nomura in 2027. It's the very next earnings cycle.
Okay, fair point.
We desperately need to see if that recent revenue miss was just a transient macroeconomic dip, or if there is a real operational slowdown happening under the hood.
That is a completely fair near-term focus, and, you should always watch the immediate earnings. But there are also unconfirmed, highly speculative catalysts brewing in the background right now that could bridge that time gap.
Like what?
Well, for instance, there are strong rumors circulating of a partnership with Infinios in the Middle East. If those rumors are true, it suggests Circle isn't just hyper-focused on Japan.
Right.
They are quietly expanding a multi-jurisdictional corporate network behind the scenes.
So if they secure regulatory approvals in the Middle East similar to what they achieved in Tokyo, you're looking at unlocking massive sovereign wealth and cross-border payment volumes well before that 2027 Nomura rollout.
Exactly. It shows a blueprint for global expansion that operates completely independently of retail market cycles. Catalysts tell us what could change the story. Now let's pivot to the chart.
Yeah, let's talk about the chart, because if we're talking about waiting until 2027, then looking at the current price action is genuinely terrifying.
It really is.
The stock is technically damaged. After that brutal 37.25% decline over the last month, the price is sitting well below both its 50-day and 200-day moving averages.
Which is never a good look.
No. And in modern markets, when price action breaks below those key trend indicators, institutional algorithmic trading bots often step away entirely. It just looks like absolute wreckage in the short term.
It is definitely trapped in a period of severe consolidation. Right now, the stock is violently bouncing in a high volatility range between $65.13 and $80.65, desperately trying to form a floor.
Trying to find a bottom, yeah.
Exactly. The key psychological support line we're watching closely is $72.87. If it holds that level, we might start to see some real stabilization.
But if you look at the technical indicators, the momentum signals are entirely mixed, aren't they?
Extremely mixed. The MACD, the moving average divergence, is showing strong downward pressure, which aligns with that crash you just mentioned.
Let's explain the MACD really quickly for those who might not use it daily.
Go for it.
Moving averages are kind of like looking at the wake behind a massive cruise ship to see which way it's turning.
Yeah.
It gives you a great sense of the macro trend, but it takes time for the wake to curve.
Right.
It is inherently backward-looking.
Yes.
So the MACD is looking at the fact that we just fell off a 37% cliff, and it is flashing red.
That is a perfect analogy. The MACD is reacting to the crash that already happened. However, if you look at the Relative Strength Index, or RSI, it is hovering around 51.
Okay, so right in the middle.
Yes. The RSI is more like checking the engine RPM right this exact second. A reading of 51 is essentially neutral, meaning the aggressive selling pressure has actually exhausted itself for the moment.
Interesting.
And on top of that, the commodity channel index is actually suggesting buying conditions are forming.
So we are seeing aggressively conflicting technicals, because the reality of this massive fundamental breakthrough in Japan is literally clashing with the short-term retail panic on the chart.
Exactly. But if you want proof that the fundamentals still matter, look at the volume behavior. When the Nomura news hit the wires, the stock spiked 5.93% intraday.
Right.
That proves that real institutional news is still a highly potent catalyst for volume. There is still explosive upward pressure coiled in this stock when the right triggers are hit.
And navigating a chart with wildly conflicting signals, like a MACD showing a cliff while an RSI tells you the bleeding has stopped, is exactly why having a clean visual workflow is so important.
It's essential.
When you are trying to map out highly specific support zones, like that $72.87 level you mentioned, getting overwhelmed by chart clutter can lead to terrible decisions.
Absolutely.
Which is exactly why traders use visual tools like VIP Algos to cut through the noise and clearly map out those zones without second-guessing every indicator. So the chart gives us price structure. But what does market sentiment look like?
Well, the chart is having a tug of war. And if you look at market sentiment right now, the news headlines reflect that exact same battle. The narrative is split right down the middle.
I mean, on one side, the news flow is incredibly bearish. The headlines are completely dominated by broader crypto sell-offs, and there are specific articles aggressively calling out Circle for facing triple risks.
Yeah, that phrase has been everywhere.
Let's be honest, when retail investors see the phrase triple risks in a financial headline, they panic, regardless of what's happening with Nomura in Japan.
Of course they do. And yet, on the exact opposite side, you have a strongly bullish institutional narrative developing. Analysts like Anton Karetinov from Traders Union are completely looking past the retail panic.
They see the bigger picture?
They do. They recognize the Nomura agreement for what it actually is. A massive, unprecedented step into the Japanese financial ecosystem.
The sentiment divergence here is fascinating. You have retail investors panicking because of an earnings miss, while at the exact same time, major global financial institutions are willingly tying their own strict compliance frameworks directly to Circle's infrastructure.
Right.
That proves institutional interest is surging. I mean, they wouldn't touch this with a 10-foot toll if the underlying plumbing was broken.
That sentiment picture is useful, but we still need to talk about the risks.
We absolutely do.
Because we need to address the elephant in the room.
Yeah.
Exactly why the stock dropped 37% and what those terrifying triple risks actually are mechanically.
Right.
We cannot just ignore the bear case.
Right, because the stock doesn't drop 37% just because the market is in a bad mood. Let's unpack the primary risk here, which is reserve yield compression.
Okay, let's get into it.
We talked earlier about how Circle is essentially a massive balance sheet business, making its money on the interest generated by the fiat reserves backing USDC.
Right, the $73 billion sitting in U.S. Treasuries and cash.
Exactly.
Yeah.
Well, as inflation cools down globally, the Federal Reserve is expected to eventually cut interest rates.
Yeah.
If you have $73 billion earning, say, 5% yield, that is over $3.6 billion in annualized revenue.
Which is massive.
It is. But if short-term U.S. bond yields drop to 3%, you just lost over $1 billion in revenue without losing a single customer. Dropping yields directly compresses Circle's margins and their earnings per share. Their core revenue engine relies heavily on interest rates remaining relatively high.
That is undeniably a severe short-term headwind. If macro yields drop, their cash flow drops mechanically. But there is also significant regulatory risk.
Oh, absolutely.
Even with the Japan approval, the Bank for International Settlements, which is basically the central bank for central banks globally, has consistently issued warnings about the systemic risks of stablecoins.
Right.
And remember, Japan's regulatory framework is notoriously strict. Any compliance stumble by Circle in Japan, any failure to perfectly execute this rollout, could be absolutely fatal to this entire institutional thesis.
So it's execution risk on a massive geopolitical scale combined with macroeconomic gravity from the Federal Reserve.
Yes. However, from a valuation perspective, there is a silver lining. Much of this risk appears heavily priced in right now.
Because of the drop.
Exactly. The market has already handed the stock a 37% haircut. For investors who actually believe in the long-term utility of a global settlement network replacing SWIFT, that aggressive sell-off potentially offers a significantly discounted entry point. The absolute worst of the bad news might already be baked into the current price on the chart.
So with everything on the table, what's the final verdict? Synthesizing all of this, the clunky reality of the current SWIFT system, the massive $440 billion daily prize in the Japanese FX market, the brutal short-term chart wreckage, and the mechanical threat of falling interest rates. Where does this finally land?
Well, based on the underlying research and fundamentals, we arrive at a bullish score of 7 out of 10.
Okay, 7 out of 10.
Yes. The final stance is that you have to be cautious in the immediate near term due to that macroeconomic yield compression we just walked through. The pressure on their margins is very real. But the company remains fundamentally strong, and we hold a speculative bullish view for the long term.
Yeah, and just to clarify the target horizon for you listening, a multi-year outlook is absolutely required here. This demands patient capital to capture the true structural value of the 2027 Nomura rollout.
100%.
This is not a quick trade or a short-term flip. You have to maintain a long-term view.
Not at all, yeah.
As always, a reminder that this analysis is for educational purposes only. It is not financial advice, and you must always do your own research before making investment decisions.
Always.
And if you want a cleaner way to read trading charts and navigate those mixed momentum signals we talked about, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TP and SL planning areas.
It's incredibly helpful.
It really is. It can genuinely help make complex charts easier to scan. But remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee results. Trading across any market involves risk, so always do your own research and manage your risk carefully. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Talk.
It all comes back to that initial contradiction we talked about. Will the digital toll bridge of the future be built fast enough to outrun the mechanical drag of falling interest rates today? That is the multi-billion-dollar question for the patient investor to watch.